Hey guys, welcome to the game plan. My name is Gareth Soloway, Chief Market Strategist at VerifiedInvesting.com. We have a huge day today. The jobs report was just released. We're going to dissect those numbers, go right into the charts, look at what the market's doing, what levels are we watching today for trades. Let's get this rocking and rolling. All right, let's kick it off, guys. You know I just wanted to throw shit, right? So we're going to get right into it. All right, so number one. As we look at the jobs report, we see that the jobs came out better than expected. Now remember, ADP yesterday, better than expected. We saw that better. We saw jobless claims lower, less people filing for unemployment. So you know what happened today? Non-farm payrolls confirmed it, that the jobs market is better than expected, or better and stronger. What does that mean? It means the Fed is not going to be cutting 6 times in 2024 like the market has priced in. We've already seen rates start to jump up. Interestingly enough, I just read an article last night that a huge trader put about a $600,000 options trade on the yields, that if yields would, or essentially by today's close, yields would jump to 4.1%. We're almost there right now. Great job by that trader. Whether they knew the jobs number ahead of time, I'll leave that for you guys to discuss. But again, non-farm payrolls, 216,000. Again, we expected 170,000. That is a monstrously better number than expected. Unemployment rate, we expected 3.8%. It came in at 3.7. So let's face it, the jobs report shows and confirms that even if the other data continues to show stress in the system, we are not seeing it translate into people losing jobs. Now, as I've said before, I still expect eventually jobs to fall off a cliff. If you go back to 2007, if you go back to 2000, what do we know from history? And this is the key, guys. History gives us a guide. It doesn't necessarily mirror it, but oftentimes it rhymes. We know that. And jobs, once they start to kind of roll over, they go slow at first, and then they fall off a cliff. Essentially, once employers that are believing that we're going to have no landing or a soft landing finally lose hope of that, they start laying off in mass. And that, again, is eventually what I expect to happen. Okay, so what we're going to do next, guys, is go into the charts. Where is the market trading? Let's take a quick look at that. All right. Now, if we go to the SPY, we are lower on the SPY, but honestly not that bad. Initially, the S&P was down fractionally going into the number. We then dumped on the spiders about $2 to $2.50. That equates to a 20 to 25 point S&P drop. We have now recovered to only down, get this, guys, the SPY is only down about 50 to 60 cents. That's a good recovery. That is a very positive sign. Maybe good news for the economy is starting to finally be good news for the markets. I don't know. Let's watch to see how things trade today. In terms of levels, we went over this level yesterday, right? So essentially the markets, if you're a technician and you're looking purely at the data, at the charts, which is what I try to do. I might give you my outlook for the 12-month period, but again, really, if you want to know what the outlook is for the next 1 to 2 weeks, you look purely at the charts, not clouded by anything else. And the answer is very simple. Well, we look at right here, right? So we have a market that goes up on the S&P about 16% in a straight line. This is just your run-of-the-mill correction at this point, or pullback. 16% up, classic retrace. We can look at Fibonacci ranges, whatever it may be, no big deal. But essentially what we have here is we have this high here and right in here, and these two things align, right? Which tells us that you could still pull back to about 458 on the SPY. And honestly, it wouldn't be that big of a deal. You would not all of a sudden be like, holy cow, we're collapsing. Oh my goodness, what's going on? It's if we get below there, like I said yesterday in the game plan, that you start to become concerned. But honestly, right here, even if we're down today again, and this would actually be very rare to have this many down days in a row. In fact, I think on the NASDAQ, you have to go back down to 2002 to find the last time we were down 5 trading days in a row. So it's been a long, long time. But in any case, what we clearly see right here, this is your level. We're trading right here as of now. Let's watch and see where we go today. Now, again, couple other charts. Technology. Technology is actually closer to technical support. If we zoom out on this, if we look at this, right? Look at the support level, very close to where it is at this point. Same general level, same general point, and this is right in here. And we're only about, honestly, about $7 or $8 away. That's your big pivot point for me. It's a former pivot point over here, a break below that. Now remember, pivots. What are pivots? Well, pivots basically tell you that as long as you're above, you favor the upside. If you get below, you favor the downside. That's why it's a pivot. It's one way or the other. And that's, again, what I'm explaining right here. All right, now again, with stronger jobs data, we should expect the 10-year to rise. It initially surged. If we take a look at the intraday, look at the pop on the 10-year yield initially. But again, honestly, look at this. We're starting to decline back down, which is why the markets have rallied off the lows. Remember, markets trade inverse to yields and also inverse to the US dollar. So I would assume the dollar, I saw it pop initially on those numbers. Now I would assume it's starting to come down just the same because the markets are beginning to rally back a little bit. But look at that move. We went right up to that key level, that 4.1%, where that trader had put that big trade on or expected it to go, and we've backed off. So we'll see. We'll see who's right out there on that number or on those numbers. Going to the daily chart, I want to just show you this real quick. Remember the levels we've hit. We've hit these technical levels here. And again, we know that we were at support. I continued to tell you guys that down here I expected a bounce. I said we overshot, and sure enough, we've continued to bounce up. I think your max upside remains back to this level, which is right around this point here, 4.4 to 4.5%. So far, we've touched 4.1%. There still leaves a lot of room to go. And again, is that going to be, are yields going to go up? For what reason? Is it because the economy gets stronger and stronger and there's no landing at all? Is the Fed going to somehow engineer this magical landing? Or is it going to go up because inflation starts to uptick again? Is it going to go up because the U.S. debt is at 34 trillion and other countries are like, no, you got to pay us a higher interest rate to take debt on? I mean, who knows what the reasoning is? There's certainly a lot of reasonings for it. But right now, again, yields certainly have come up and starting to move back to the upside. Looking at the U.S. dollar real quick, and we're going to fly through here, guys. I got a lot to cover today. Take a look at the dollar, and this is exactly what I thought was going to happen here when we just looked at that previous chart where we could see the dollar has pulled back off the highs. Let's flip over to the 10-minute chart. Wow. Holy cow. Look at this. So again, the dollar initially, huge pop, but look, the dollar's actually gone negative. So how, I mean, basically, as a technician now, we have to figure out why is the market discounting this level or this jobs claim, job unemployment number? Is there some alternating data that's coming through? Are the underlying factors? And these are things that, again, as a technician, we have to look into. We have to find out, okay, well, why were the jobs so strong? Maybe it was because the government did all the hiring. Maybe there's weakness in most sectors, but it's one sector that is abnormal because of some factor. And ultimately, what this is telling me is that the market is telling us that the jobs number, yes, it was stronger, but it's stronger for a specific reason that the market does not believe will last. And that, again, that's me reading the charts. That's just what the charts are telling. The charts are the ones that are right. Doesn't matter that the number was better than expected. It's what does the market react to? And that's what, again, throughout the course of the day, we need to watch the market. Where does it end today? And ultimately then extrapolate what the market is telling us, not what we're telling it based on what we're seeing, right? The market, again, is always right. Not me, not anyone else. Okay, so I want to just show you something really cool here on the chart, guys. So if we go back to this chart, daily chart of the US dollar, I want to just do something with you guys, a little bit of a kind of an experiment here. And so what I want to do is if we zoom out on this dollar chart, and I'm actually going to erase these trend lines. Let's get rid of all our trend lines here so it's just a clean chart. We basically had a pivot high on the dollar back here, right? We then had a secondary pivot right here. Now, what's interesting, if we look at that secondary pivot, right, and we do a Fibonacci from that high, so from this high to the lowest point down here on the dollar, how much of a Fibonacci retrace was this? Let's do it right now, okay? So let's stretch that and notice the lowest line is going back down to the exact low, and isn't that cool? Look at this. So basically, if you take your highest point to your lowest point, the retrace on the dollar right here is exactly at the 50% retrace trend line on the fibs. Now, what I do here is I start to extrapolate this out. And by the way, this doesn't guarantee me a win or being right. It's just These are the experiments that I do. As a technician, I'm doing multiple things and trying to see how many factors I can get at a specific level. The more factors, meaning, a bull flag, a bear flag, a topping tail, a bottoming tail, a fib retrace, a gap fill, whatever it may be. I mean, there's like 50 different factors that could be. But the point being is that what I'm doing here, what I find fascinating is I'm extrapolating out one of these techniques is to say, okay, from this peak, right, from this peak here to this low, this is a 50% retrace. So from this peak, as we are bouncing, what would be a 50% Fibonacci retrace, right? So again, here, just simply let's zoom in and we'll do from here down to here on the fibs, and that gives us a retrace. Interestingly enough, look at where the 50% is, right here. And look at that, right there. Okay, so does it guarantee that the dollar would go there? No, but if you have a congruence or a confluence of factors, it gives you maybe a slight edge of where if the dollar goes, it may run out of steam per the last one. So you guys see how I'm using a last move and the kind of the symmetry, if you will, of a last move in the retrace to maybe help me predict where it could go. And again, the biggest thing, and this is something that so many people don't understand out there, is that there's no guarantees that that's what happens. That's not the point. The point, again, is to try to find a confluence of factors that at least gives me an edge. And that's all a trader can ask for. That's all an investor can ask for is an edge. All right, that's it. That's it. It doesn't guarantee being right. It's about getting an edge. And so I'm just showing you essentially one of the things that I use to help me predict. And I really am looking and saying, oh, okay, well, at least that's at that level. So that's 2 factors. I like 3 factors. 3 factors, and that's in my methodology, the Winning Trader series, that's exactly what I'm looking for. You get 3 factors, you should get your probabilities up to about 70% success rate. Now, you have to be okay with there being very few trades. I'm okay with that. I've been trading for 24 years. I don't need 1 million trades a day. You give me 1 good day trade a day, I'm happy. You give me even 1 swing trade a week, I am happy on that front. Okay, let's go on, guys. Apple. So Apple has rallied already back. This is driving me crazy. So pre-market, I had an order out to buy Apple at 179.97. All right. When the jobs number hit, the stock came down to 180.10. I missed getting filled by 13 cents on a nice chunk of change. Now you might say, well, why were you looking to buy Apple today? Very simply put, you have the daily 200 moving average right here at that exact level. You also have a myriad of selling pressure that's knocked Apple down. It's now oversold. And again, we've talked about this before, but you have levels right in here that, again, give us a general consensus. Now, there is a trend line down here that would be my secondary add level if needed. But today, it's a shame that that didn't get hit. I would have liked to have gotten filled on that trade this morning pre-market. All right. Couple other charts I want to go over. We should look at Tesla here. Tesla, I know, is a favorite. It's a fan favorite out there, so let's take a look. I think it's so cool to see these levels here, guys. Again, look at how the trend lines really do help predict where price is going to stall out. And you can see we literally went up to that level, and then we've had 1, 2, 3, 4, 5 down days in a row on Tesla. What I want to show you, too, though, is that, again, remember the confluence of factors. So what else can we find here? And what we can do is if we zoom out on the chart, we can take a trend line and we can absolutely drag it down here and look at this. Now that is cool, right? So you guys see what I'm saying? So you have this line here, right? And it goes right there. And then you have this secondary line right here and it goes right there. When I talk about a confluence of levels, these 2 lines literally meet right there. What that does it guarantee me a win on a short here? No, not at all. But what it does do is it raises the probability that I will be right. The more factors at the same point of contact, the more the odds of you winning on your trade go up. It's very simple. I mean, it's really about stacking the odds in your favor, literally by stacking the factors. That's what it is. All right. So again, crazy stuff here, guys. Let's jump back to center screen here, guys. Couple things. So it is Friday, and as you guys know, I'm loving these things, and I'm going to continue. I'm glad I got the great feedback on the pregame. We're going to do that just once a week, probably every Friday. So starting next Friday, I'll try to do the pregame where you guys actually see what we're discussing before I come on the game plan in the real trading floor here, which is awesome. I do want to take a minute just to thank LuxAlgo. They are a sponsor here, and they are awesome. We're going to take a quick 30 seconds to just view a quick little tidbit on them. Take a look at LuxAlgo, guys. It is awesome.
Have you considered enhancing your trading experience? We have an amazing tool for you. LuxAlgo creates next-gen trading indicators to help the world understand the markets in a smarter way. They have the largest user profile on TradingView and are the only official Discord partner in the technical analysis space. LuxAlgo Premium operates seamlessly with top platforms, such as TradingView and Discord, making it the perfect tool for every trader. Take your trading analysis to the next level with LuxAlgo. Please visit the description below and sign up for LuxAlgo today.
Right, we're back, guys. Very cool stuff. So just in the spirit of throwing things, I'm going to do one right here. Oh, almost hit the camera. These are little Nerf ones, so I can do them very easily. Oh, there we go. All right, anyways, getting back into the charts, guys. I'm just having some fun on a Friday. But basically what we have here, folks, is you have Bitcoin still trading within a range. Now, I want to point out one thing. Coming into this week, you saw whips up and down on Bitcoin. All right, you had, oh my goodness, they're going to approve the ETF by Wednesday. Oh no, now it's going to be by Thursday. Oh, now it's going to be by Friday. And then in the middle of that, we had, oh my gosh, they're not going to approve it. And this is all BS, right? I mean, again, they're going to approve the ETF. It's just a matter of when. And I want to say the reason why I'm so confident that they're going to approve at least one of the ETFs, and probably a few of them at minimum, is because literally I'm watching CNBC every morning now this week, and there's Bitwise commercials for the ETF on TV on CNBC. So again, Bitwise is not putting and spending money on commercials unless it's going to get approved. So it's going to get approved. But the question that I have is, which way does it go? And that's what the charts are here to tell us, right? So very clearly, we're stuck in this channel. I love the simplicity of this channel. I don't have a bunch of crazy stuff all over that is confusing here. It's a channel. We know our upside target still remains at 48 to 50,000. That would be best case scenario. The downside, if we take out this area down here, we then have downside to 38,000. That's your first big support. 38K. If that breaks, you then have support at 30,000. Now, there's been lots of people, I mentioned 30,000 just a couple days ago or even yesterday in this stream, and people were like, oh, it's never going to 30,000 again. The more people say that, the more I actually think it will, because there's a tendency for the market to flush it to levels where people get whipped out of the trades, right? So again, I have no clue where it's going to go. I don't know, but I do know that market sentiment is a inverse indicator, meaning that the more bullish people, the more people that pile into a trade, the less additional people there will be to buy the good news, thus sell the news events. That's why we saw, for instance, NVIDIA. I still remember vividly. NVIDIA comes out after hours with incredible earnings, one of their last conference calls, jumps to $520 after market. It then sells off from there down to like 460 by the next day or 470. It was a sell the news event. Their earnings were amazing, like blockbuster, but everyone had piled in anticipation, and therefore people started to take profits once the news was out. Okay. So we know our levels here. Again, to the upside, we have the 48,000 level, all right, 48 to 50K level on Bitcoin. Those would be your two levels on either side of price. The way I work is very simple, guys. It's price dictates action. Okay, meaning that if we break above 50, we start looking at what the next target is. If we break below the 38 level, we start looking at 30. If we break below 30 at some point, even if it's unlikely, we then start to look at the next level. Doesn't matter what you and I think is going to happen. The market couldn't give a crap, frankly. It's about the levels. When one breaks, you look to the next one. Very simple. Okay, let's go to the gold chart, which again continues to kind of jumble here on things. We're not seeing a whole lot of action here. Gold continues to be just down slightly, trading at 2043. This again is the weekly chart, I believe. Yep, the weekly chart. So again, I'm just pointing out here that we're still below this level. I know everyone wants their update on gold every single day, but honestly, there's not a whole lot. And by the way, same thing on Bitcoin. All these whips are just to make you get anxious and nervous and try to whip you out. It's either trying to get you to put leverage back on at 25x, or it's trying to make you panic and get wiped out and dump. That's all this action is. This is classic action by the algos that are like, hey, whoever's over leveraged, we're going to hunt down your leverage and get you out of the trade. That's what they do. So this is why leverage is honestly one of the worst things you can do as a trader. It's what, honestly, traders that have very little money are more apt to use leverage. Leverage creates more losses, and therefore traders that are poor stay poor. This is what it is. It's being consistent and growing. Like, you could start with $1,000 account. If you start with $1,000 and you compound, let's say 30% a year, which again, in the markets, that can be that's a great return, but in the crypto markets, it's honestly crappy, right? I mean, so to a lot of you guys, you'd be like, oh, 30%, what the heck, 30% a year? But compound that year over year for 10 years, see what number you come up with, versus what most people will do is they'll blow up their account after 1 or 2 wins, making 100%, they'll blow it all up and have 0. All right, oil. Oil is upticking just a little bit today. There's not a lot of new things here. Again, we talked about the Head and Shoulders completion. Where could oil go? One of the things I'm watching on oil, and I'll just throw this trend line in here, is this trend line here, right? So we are up against a very important level on oil, right? So again, we have this pivot point right up here. We touch it here, and we touched it here. We pulled back, and now we're up against it again. If oil breaks above this level, which is right around, let's say, $75 per barrel, we're now talking about a potential bigger move to the upside occurring. It would be a breakout of the general downtrend. Now, you will have stopping points at certain levels along here. I don't know which one it would go to necessarily, but what I do know is this trend line has been a downsloping trend line of significance, and if we do break out of it, you likely get a move probably back into the $80 range. Now, again, is that inflationary? Yeah, I mean, it would be core upticking in inflation again, which again is one of my main theses for why the Fed is going to have so much trouble cutting 6-7 times in 2024. It's not because I don't think the economy gets weak later in the year. It's because I do believe that inflation is going to get sticky around 3%, and it's going to have a hard time breaking down to that 2.5% to 2% level where the Fed would feel comfortable that they're not going to repeat what happened to Volcker in the 80s, right? In the early 80s when he cut too quickly and inflation roared back up. Okay, quickly touching base on silver, guys. Silver has had a little bit of a rough go on the charts. It has come down obviously more than gold, but it is still holding this trend line here. So if you remember, we talked about this level here, this level here. Yesterday we were below, we closed on the line. Today we're on the line again. No breakdown yet, but again, short term, I'm watching this level right here. We'll see what happens. Ultimately, the macro chart, the monthly and the weekly, are still very bullish. This is the daily chart, which is giving us a shorter time frame of outlook. The daily chart, just a reminder, gives me an outlook of about 2 to 4 weeks out. So what is price action going to do for the next couple weeks? That's what it's telling me. If I'm looking at the weekly or the monthly, it's telling me 6 months, a year out, more significantly. So again, it's important to understand as a trader, I'm a trader, right? I'm a swing trader, I'm a day trader. I'm focusing on shorter time frames because those are the ones where I can go in and I can go out multiple times. If you're someone who's just sitting at home and you're like, hey, I'm going to hold for multiple years, you should honestly, I would ignore the daily. I would go to the weekly or the monthly chart and do your analysis on those. Lastly, guys, just touching base on Nat Gas. Yesterday, I told you I did take profits on this with members at InTheMoneyStocks.com. And sure enough, look at that nice red candle right back down. And again, hopefully you guys can see that. I can zoom in. But beautiful red candle back down. Now, again, doesn't mean it's not going to rally back up. But what I did was I did a risk assessment yesterday. How much have we rallied off the lows? Are we into resistance? Yes, maybe a minor resistance, but still it's extended into resistance. And again, the thought process was, do I want to squeeze just a little bit more juice out of that lemon? Or do I want to say, you know what? I'm okay with a 14% gain here on this trade that was a little awkward when it went a little bit below the levels I thought. The answer was yes, check it off in the box, take those profits. And now the beauty of this is if it pulls back, we can look to actually rebuy right in here, right? Right in this area here, which was resistance. Remember how price broke here, which I was surprised at. It then came up, pulled back, came up, pulled back, all that price action. Now we broke out. Now if we retrace, we can actually rebuy here. And that is what it's all about, guys. It's about trading the markets. That's what I like to do. I try to give a little insight into how I do things here. I hope you guys are okay with that. But as always, guys, it's cool. So let me jump back here, guys. It's time for me to end this Friday session of the game plan. This is every day, Monday through Friday. If the markets are open, I am here with you, and I'm going to guide you guys into doing everything I can to help you understand the markets, the inner workings, what the charts are telling us, even giving levels and potential trades. Obviously, you guys make your own decisions. I make my own decisions on what I end up doing. Have a wonderful weekend. Thank you guys for tuning in. Have a good one. Take care.